Okay, so section for chapter 3 asks, all right, when journalizing a transaction, which statement is true? Yes, your debits must equal your credits. Okay, always. Okay. Number 15, okay? I spelled that wrong. What are the methods used to correct errors in journalizing? I'm having struggle reading. All right, once again. All right, so A and B. Good. Error cancellation and reverse and reentry. Yes. No such thing as cross it out method. Yes, the answer is D, A and B only. Okay, so here we go. Number 16 says that you made a purchase of office supplies for $56, okay, cash, okay? And then you recorded it in your journal, okay? Office supplies for $65, okay? Correct this error in the entry using both methods. So first one is going to be reverse and re-entry. So how am I going to fix this error?
Accounts payable.
Okay, we use cash.
Oh, sorry. So yeah, cash.
Okay, so we're going to recognize cash first.
No.
Office supplies.
Okay, so we're reversing our entry, right? We already purchased the office supplies for $56, but in our journal, we recorded it as 65. So in this case, we're doing the reverse and re-entry. How do we reverse the transaction?
You want to put back the $56 in cash
Mm-hmm.
as it never happened. Your
Yes.
example is go to the store, do your return.
Good. Office supplies, right? Here I am. I'm returning my office supplies for the $65 because that's what I journalized it as in my books. Okay? Now that I'm done with that, now I need to re-enter it. So how am I going to re-enter it?
You have that reversed. You originally put it in for 56. Oh no, you made the purchase 56. Okay, I'm sorry.
Okay, good. All right. So now I went to the store. I physically returned my office supplies for the amount that I've written it as in my journal. So how am I going to re-enter it now?
Now you'll go office supplies for $56 debit and cash for $56 credit.
Good. And now we're going to re-enter the transaction, but this time for the correct amount of 56. Okay? Excellent. So then, how about error cancellation? Okay? What's the difference between 56 and 65? $9. Now let's understand this. I originally placed it in for 65. But how much did I actually purchase it for?
56.
56. So, how should I correct this entry?
You're gonna credit $9. You're gonna start with the debit, or yeah, that will be for. Let's see. I just had it when you start typing. You're gonna debit your cash for the $9.
Oh my gosh, where is my C at? cash, and
Yeah, office supplies, you'll do the credit and then put a little note um, for the adjustment entry.
yeah, on whenever the date was, right?
Yes.
So, yes, that's correct. Because in this case, I originally journalized too much money. Like, I'm only supposed to be spending $56. But in my journal, I said that I spent $9 extra. And on top of that, my office supplies has too much in it, right? In my original journal, I journalized it as 65, when in reality, I only have 56. So in this case, what I did was I debit back my cash because I did not spend those extra $9. I have to credit my office supplies to reflect that I don't have 65 anymore. I have $9 less in my account. So this is correct. You're going to debit your cash and you're going to credit your office supplies because my office supplies is too much and my cash is too much. So I need to put it back. Or in this case, take it out. Okay. So good. All right. Then number 17 says, what is the difference between the general journal and the general ledger? So we went over this earlier. A, the general journal has a list of all the transactions with balances. Okay, now is that correct? Does the journal list out all the accounts with their balances? No.
Well, it's going to be B because that's the only thing that says only list the daily business actions and transactions.
Does the ledger do that though?
Yeah, but don't you put the day then what you did through the day, like uh, debits and balance, debits and credits, and I'm making me repeat myself.
Okay, let's explore C. The general ledger, okay, is a list of all the accounts with their balances. Isn't that what we just did yesterday? We listed out our first account, which was the accounts payable, right? And what did it give us?
Oh,
It gave us an account balance,
see.
right? The journal only lists the daily transactions that happen in the business, right? Nowhere on the journal do I see an account balance. Okay, so A and B are reversed, right? They're each other's definitions. So C is the correct answer because the ledger is the only one that's going to show you your account balances. So in this case, the answer is C. Okay, this may be a true or false question on the exam, so make sure you guys know the difference between them, just like knowing the difference between the bookkeeper and the accountant, knowing the difference between the double and the single entry, right? Also, same thing if I were to ask you what's the difference between the accounting period and the accounting cycle. All right? There are a few things that you're going to have to be making sure that you know and you're aware of. All right? All right, next section is chapter 4. So, what I'm going to do is I'm going to go ahead and pause here because I want to go over chapter 4 and then go over the questions. So, then you guys kind of have a little refresher instead of having to struggle through this. So, chapter 4. Can you guys see my PowerPoint?
Yes.
Okay. Chapter 4. Once again, the accounting cycle. What is it? It is a systematic or methodical series of rules and regulations that ensures the accuracy of our accounting. Okay. So what it truly does is it allows us to analyze by using our collective process of recording, analyzing, processing, all those, terms, accounting events or of a company, right? When we look at business transactions, right, we're constantly completing the accounting cycle, right? It's a list of steps and rules that you have to take. You have to complete, usually at the end of a given period, which we'll talk about in a second. And these 10 steps are going to reflect every possible way to ensure the accuracy of your accounting, because every journal that we do, right? Every ledger that we post to, every trial balance that we complete, all the way down to the financial statements, right? It's proving something, and whether it's when we complete the trial balance, right? Our main goal there is to make sure that my debits match my credits. My financial statements ensure my profitability, but it also ensures that my assets equal my liabilities and my equity. So overall, it's a collective process of just collecting everything, recording, and processing it through the accounting cycle. Okay? And we also have to know that the characteristics of financial statements is going to be the 2 R's and the 2 C's, right? It must be reliable, right? So reliable, because hence we need some kind of proof that a transaction has happened, right? That's the reason why we have a source documents, to prove that a transaction has occurred. And when we reflect that in our financial statements, because we have the source documents to prove it, it makes our statements reliable, right? We can trust the information in our financial statements because we have proof to back it up. All right? Second thing is it's got to be relevant. Relevant meaning within its given time period, right? If I'm going to be utilizing or journalizing my transactions, usually it's within like a certain amount of time period, right? If it's the month of January, then my transactions are all going to be in that January of that year. Okay? It wouldn't be relevant if I were to journalize something 10 years ago and then journalize something, today. Because with relevancy, I cannot expect that 10 years ago that my prices are going to reflect the same as today. So being relevant is being current with the times, right? You're staying within relevancy. The tax rates are all within the same year, not different years, okay? They're all going to be relevant. Consistent. So consistent meaning if you choose a method. So when I talked to you about this on the first week of school, right? We just learned that there are 5 methods that exist, right? We got a bookkeeping system, right? So between single versus double. We have the difference between the accrual basis versus the cash basis. We got to take a look at the different methods that we use, right, to keep track of inventory, right? We got periodic, we got perpetual. Then we also got to think about what method that we use to cost out those inventory items, right? Whether it's LIFO, FIFO, or weighted average. You need to be consistent. So choosing one method and be consistent so you have some kind of formal or formality that allows you to reflect and compare your information, right? Being consistent is key, because if you choose this month I choose this method and the other month I choose another method, how can you compare them? They're 2 different methods. You're not showing some form of way to prove consistency, right? Your analysis between the 2 months are going to be completely different, because one is using cash basis and the other one is using accrual basis. So you need to be consistent and choose one method, all right? I'm going to explore all the methods, but whichever one works best for your company is what you're going to choose, okay? And then lastly, being comparable, right? When we're looking at comparing our financial statements, the main goal is to create our financial statements for the purpose of our external and our internal users. We need to make sure that our books look good enough to compare, especially for our external users, right? are investors. If an investor wants to make an executive decision to either invest in your company or another local business, the first thing they're going to do is they're going to compare to see if your financial statements are looking good. If you can show that your profits are really high, but you show that your balance sheet is really bad because your assets don't match your liabilities, then you can definitely see that they're more likely to choose or invest into another company because their financial statements are more cleaner, or I don't know, they're more to what they are appealing to, right? More profitable maybe, okay? So being comparable, right? Not only does that compare for external, internal as well. So like I've mentioned before, if you're being consistent with a specific method, you can compare your profits from month to month to month, right? Making sure that you can create your profit margin, right? So those are the definition. That's the characteristics of your financial statements, that they must hold these 4 characteristics. Okay. So once again, here are the 10 steps of the accounting cycle, right? We guys start by collecting our source documents, right? So once again, collecting your source documents could be collecting your receipts, contracts, invoices, bills, whatever source of information that proves that a transaction has occurred and that it is within the business, right? If it's a transaction for you going your personal shopping, that does not matter. It has to be within your business, right? So any kind of proof of documentation that a transaction has happened. And most common one would be a receipt. Okay, contracts, all right, are also one of them. Bank statements, all right. So once you've collected your source documents, the next you gotta do is you gotta analyze it. So for the example, we take this receipt, we're gonna answer 3 questions. When did it happen, right? Usually the receipt will have a date. What has happened? Well, you went to the store and you bought office supplies. So therefore, you made purchases of office supplies. The how is going to be, how did you pay for it, right? I paid for it within cash. Okay? How much was my office supplies for? Okay? It was for $61.09. Okay? So again, we're going to be taking a look at analyzing the source documents and determining how does this transaction, right? This is also going to be in relation to your transaction analysis, right? How does this transaction affect your business? I purchase office supplies because I'm printing stuff. I'm printing out receipts, invoices, bills, whatever it is. I need to buy a printer paper and printer ink. So how does that affect your business? This is exactly what it does. I need to buy these office supplies in purpose to operate and continue doing my business. Okay? Then step 3 is going to come to play, where we actually journalize our transaction, right? After we've gone through the 7 steps of transaction analysis, right? We determined, yes, we're going to do it. We figured out what accounts we're going to use. We figured out which amounts are going to go into it, which side goes to the debit, and which side goes to the credit. Step number 7 says, do it. So here we are. Step 3, we're journalizing our transaction. Okay? Then step 4 is we're going to post it to our ledger. So as I've mentioned before, and we've got to take a look at yesterday, for every account that we utilize in our journal. So here I use office supplies, and here I use my cash account. So therefore, when I post it to my ledger, it's going to reflect the accounts that you used in your journal. Hence, my cash account and my office supplies account. And each one, like I said, is going to have a running balance, right? In this case, I debited my office supplies, so that means I should have $61.09 worth of office supplies in my assets. Here, I spent cash, so therefore, I credited my account. So now I only have $1,938 left in my bank account because I made a purchase of office supplies. Okay? So that's posting to the ledger. Then next is going to be preparing a trial balance. Now, a trial balance can be done whenever you feel like it. It's very important, especially if you're doing a company that does like a million transactions every day. Running a trial balance every day would be ideal so that you can make sure that your debits and your credits are in the correct location. All right? If you see that they are not balanced, you made a discrepancy somewhere in your accounting. So you have to go back to your ledger, you got to go back to your journal and locate where you made your mistake. Okay? All right? Most commonly, step number 5 would happen towards the end of the given period. Okay? And we call that the unadjusted trial balance. So that's this one right here. I'm comparing all my stuff. My debits and my credits match. So that's the end goal for my trial balance. Then I'm going to go over step number 6, which is to go through the adjustments that you need to make at the end of each given period. Okay? So examples are going to be periodic inventory, which we just learned. Okay? Things that we will learn will be depreciation / amortization. Supplies expense, right? If we bought supplies, how do we use our supplies? That's right there. Cost of material, which we will learn in our fictitious business, and bad debt expense. Bad debt expense is going to be chapter 10. All right, so things that we will learn. Okay, so once we created our adjustment entries, next we have to redo a new trial balance, but this is adding in our adjustments. Okay, as you can see, I adjusted my supplies, right? I no longer have $60.09. I have now $11.09 because I spent $50 worth of office supplies. So here, I've recognized that I used $50 worth of my office supplies. Okay, depreciation, etc., right? Once we do that, the next step is going to be computing and creating your financial statements. So once again, we're going to go through every single one. Income statement first, statement of equity, balance sheet, then the statement of cash flows. Then we're going to close out our temporary accounts into our income summary. So once again, this is more relevant towards the end of the class when we actually go ahead and compute this and close out the books for our project. That's what we're going to be doing. We're going to take all of our sales and close them out to our income summary. We're going to take all of our expenses, close them out to income summary. And then last but not least, your income summary is going to close out to your equity. Okay? Then, to ensure that you did this correctly, you're going to run your last post-closing trial balance to ensure that your debits and your credits match, that you didn't accidentally, debit your cost of goods sold or an expense account, okay? So then we're going to talk about the accounting period. Are you guys still there? Okay, you guys were just extremely quiet. I just didn't know if something happened or not. All right, so accounting period, right? We talked about this. The accounting period could be almost anything, right? It could be on a daily basis, a weekly basis. It could be every half year, every month, every 3 months, right? However you seem fit for your company. Now again, when do you schedule your accounting period? It is when you schedule to complete the accounting cycle. Now, think about it. When we go through the fictitious business, you're going to see how overwhelming closing out the books are. And ideally, depending on what kind of company you are, you're going to see which one fits best for you. Now, there are 10 steps to the accounting cycle. If you're going to do that every single day, good luck. Okay, but yes, anyways, it's just depending on what your company feels fit, right? You're not required to have to compute it every day or every week or every month, but you have to complete it at least at the end of the year. Okay, that is a gut rule and guideline. Okay, and we'll talk about that later on. But yes, you could choose how you want to schedule to complete the accounting cycle, all 10 steps. You can't stop halfway. You have to complete the whole entire cycle. That means running all your trial balances, running all your financial reports, etc., etc. Closing all of your accounts, okay? And then we talked about calendar year versus fiscal year, right? This is just based on how you file your taxes to the IRS, right? What do you seem fit for you? Would you rather do it in the middle of the year, or would you rather do it during the end of the year? Okay, so most companies, if not, they, it's easier to just memorize and, focus if you just do calendar year. But most government agencies or anything that are less likely to be less busy during the summer, they're more likely going to be fiscal year, right? Difference between them is they're still both one whole entire year, right? They're both 12 months, but the only difference is that calendar starts on January, ends in December. Your fiscal year starts on any first of the month all the way to the 12th of the end of the 12th of the month, okay? That's the only difference. All right, generally accepted accounting principles. Now, this is very important that you need to know. I am not going to require you to know who created it, but I do need you to know, what does it stand for, okay? And what I mean by stand for is you need to know it's generally accepted accounting principles. These are the rules and guidelines that governs every single thing to ensure the accuracy of your accounting. All right? So once again, we talked about the assumptions. First assumption here is going to be your business or an economic entity, right? This tells you that you must create some kind of difference between your business and your personal transaction. So, great example is going to be creating a separate bank account for your business and creating a separate bank account for your personal banking, right? That's a good example. That allows you to be able to tell the difference between a business transaction versus your personal transaction, right? And allows you to spend different money for different reasons, okay? Then we have going concern, right? This is the assumption that no matter if there is a foreseen foreclosure or a foreseen event, you are going to continue operating your business as if nothing's wrong. So continuing on until you are ready to stop doing business or whatever, for whatever foreseen event that happened, right? So a perfect example, right, is Sears. Sears was going bankrupt and they filed for bankruptcy, but because they were doing that, they were in the process of trying to get rid of all of their inventory. So they continued to conduct their sales until the door closed out, where they were completely out of business, right? They needed to find some way to liquidate their assets. They needed to find some way to get rid of their inventory. So they continued conducting their sales as usual, okay? But with, special discounts and whatnot. So they still continued business even though they were going to close out until they officially closed the doors and they can no longer do business anymore, okay? So that's that idea there. Monetary assumption. There are three things, or it breaks down into three things, right? First is determining what kind of monetary unit you're using. So, of course, in America, what are we using? The US dollar, okay? If you are using foreign money or cryptocurrency, I believe cryptocurrency is technically a form of currency. However, it's not widely recognized. It is in the process to becoming recognized. But right now, for the United States, we are still using the US dollar. Okay? If it's foreign currency, you're going to unfortunately have to convert that, go to the, foreign exchange and convert it into cash, whatever it is, right? You need to make sure that that's in terms of US dollar. Okay? Next one is going to be monetary measurement, right? When we journalize, notice this. We never journalize based on quantity. We've always journalized based on the total value or the total cost of whatever that we purchased, right? So in this context, right, this assumption tells us that if we are incurring any expense or making purchases of anything, we need to make it in terms of dollar value. So for example, here, I have a bunch of employees, right? I have X amount of employees. I cannot journalize that. I have to journalize it in terms of how much it's going to cost me to have all of these employees. Okay? So that's just that monetary measurement. It has to be in terms of dollar value. And then wherever you place that information, right? You can place in your journal, right, under your description, but there is a place for it, and we'll talk about that after this. And then stable currency. So we talked about the U.S. dollar, right? It is the most stable currency because, again, when we're taking the aspect of the US dollar, we can make projections without having to include any inflation or any of those ideas, right? We can take the dollar and we can, project maybe 5 years from now that it's not going to change that much. And it's true, right? The dollar 10 years ago, okay, yes, it changed a lot, but in terms of how much it expanded or how much it lost value, wasn't that significantly different. Now that we're in a, I guess you could call this a recession, depression, whatever it is, right? Yes, the U.S. dollar has expanded incredibly by a lot. It lost its value so much because of the pandemic. So in this kind of aspect, we can still use the US dollar to make projections in the future without assuming those inflation. But, right now, we have to just understand that the US dollar is not going to be the same in the future. But with this idea, it's just saying that the US dollar is stable enough to be able to make those projections in the future. So again, what this assumption is telling me is that if I were to create a project, if I predict it's $50,000 today, that means when I actually incur it and go through it, it should be roughly $50,000 in the future. That's all that little section is for stable currency. Then last but not least, our last assumption here is going to be the accounting period. So in this case, the United States GAAP allows us to break our accounting period into sections to make, us to do projections or to make us, compare our profits. So once again, if my accounting period is monthly, right, I can run a profit and loss every single month just to determine how much profits my company is doing, right? Is it doing good? Is it doing bad? So that's what this accounting period assumption does. It allows the company to break down the accounting period into weekly, daily, monthly, right? But as long as it's within a consecutive year, okay? So that's one thing that you need to know, that They require it for 1 whole year, but you can divide it into as many parts as you want to, find some kind of measurement for profitability or whatever you want to use it for. Okay. All right. Basic principles. Once again, first basic principle is the historical cost, right? We haven't take a look at purchasing fixed assets yet, but we did got to take a look at looking at our inventory, right? When we purchase our inventory, right? We purchase it at the original selling price. So in this case, an example of utilizing this historical cost is if we were to purchase a machine for $50,000, okay? That means in your book, it's going to hold its value for $50,000 until the day you decide to sell it. Okay? Or get rid of it. All right? Other exceptions to this rule, once again, we also got to take a look at lower cost of market, right? Our inventory is one of those exceptions to these rules because we cannot expect that when we purchase our inventory, it's going to hold its value over the years, right? We talked about an example of a lower cost of market, right? Electronics, anything that's electronic typically will lose its value over years because of the vast majority of it, technological advancements, right? Better cameras, better vision, better view, whatever, better screen, better materials. Things are just going to continue to progress, right? And technology is going to progress. So that's why our inventory is going to be one of those exceptions. Another exception to this rule is also going to be any bank bonds or any bank securities, right? The purpose of you buying it at the value as it is today is so that in the future it's worth more in the future. So that's going to be one of the exceptions to this. Okay. Then we talked about revenue recognition slash realization. Okay, so it's pretty straightforward into understanding when we actually record our revenues. Okay, so we only recognize or realize that we gain a revenue once the task has been completed. Okay, so once it's been earned. So the example I put here is when we're recording sales, right? We record it at time of when the item is sold, right? We don't record it when cash is given to us, regardless of cash is given to us, right? As long as we completed a sale, we earned the revenue, okay? And this is going to go hand in hand with the matching principle because the matching principle says that all expenses that are related to earning or generating our revenue is going to be equal, right? So for example, when we made that sale, right, our equal part is going to be the cost of goods sold, which is directly correlated to our inventory, right? And it's also going to include our profit. That's going to be our expense that it takes for us to generate, and that should match the total value of what your revenue was for. Okay? Last but not least, we're going to talk about adequate disclosure. Adequate disclosure, once again, is basically it's a place for you to disclose pertinent information for any transaction, right? So for example, right, we talked about the monetary measurement. I have X amount of employees. So the place that we're going to reveal this information is going to be what's called the notes to the financial statements. So this is where I can record the number of employees that I actually have, right? Because if I just journalize that I have $100,000 worth of employees, can anyone tell me, do I have 10 employees or do I have 20 employees? That's where the notes to the financial statement is going to reveal, that my company is consisting of 10 employees and they cost me $100,000. Right? All right, and then last but not least, the constraints and conventions. These four I will not test you on, so I don't even want to bother to even go over it. Okay? So we'll skip that right now. Right? Then we talked about cash versus accrual basis. Pretty straightforward. When you're dealing with a cash basis, if you can understand, you only record revenues when cash is received. You only record your expenses when cash is readily available to spend. Whereas the accrual basis, you're going to record a revenue when the transaction has occurred, or in this case, when you've earned it, right? Regardless whether you received cash or not. It doesn't matter. You sold the product, boom, you earned the revenue. You finished your job, boom, you completed your task, whether you received money or not. That goes with your expenses as well. If an expense has occurred, so the day that it happened, whether you paid or not, you're going to record that expense. So when it has incurred, okay? So once again, I gave you a little example here. If I had a paint job, right? Or I'm sorry, I think this is the construction one. If you were supposed to be assigned to build a building, right? And they gave you money on the 1st of January. On a cash basis, you would record that you received the money. Right? But in April, you wouldn't record it at all because you've already received the cash for it. Right? Where under the accrual basis, you would not receive the money yet because the task has not been completed. However, in April, once the task has been completed, the building's done, that's when you recognize the cash or the service has been completed. Okay? So again, same thing with this one, except reverse roles, right? What if you got paid in April, then this would happen. Okay? So once again, chapter review. I'm going to only test you on just knowing the 10 steps and the order that it goes into. I'm not going to go through, I'm not going to test you on each individual step of the accounting cycle. I just need you to know the basics because throughout this entire class, you will be learning all 10 steps, okay? But that's not going to happen until we actually complete our class project. So once again, I'm only going to be testing on you just to know what the steps are and what order they come in, the order that they are completed in. I may ask you a question on the accounting period, right? It could be daily, it could be monthly, but you need to know the definition that it is when you are scheduling to complete the accounting cycle. Calendar versus fiscal, right there. Your character versus the financial statements. So once again, you need to know your ABCs, right? Your assumptions, your basic principles, and your constraints. I will not test you on the constraints, but I will test you on those first 8. So the 4 assumptions and the 4 basic principles, okay? I can test you whether it's definition based or I can ask you to apply the definition and pick from the choices which rule reflects this task or the scenario, okay? And once again, making sure you know the difference between a cash basis and an accrual basis, okay? So with that being said, so here we are, chapter 4, okay, question number 18. Can you guys see the study guide? Okay, just making sure it's working. All right, so which of the following steps belong to the accounting cycle? Okay, here you go. I listed all 10. Now, can you tell me which one belongs to the accounting cycle? All of the above. So you need to know the exact order because I will give you, just like the one of the quiz questions, right? I will give you which one best describes the accounting cycle. And if I put, step 7, step 8, step 9, and then step 10, that's going to be more likely for what the accounting cycle reflects. So I may ask you something similar to the quiz. So yes, D, all of the above is correct. Number 19. Okay, which of the following is not a characteristic of financial statements? B, reasonable. Yes, it is definitely not reasonable. Okay. Number 20. Okay, under the rules of GAAP, which rule states that a personal asset should be separate from your business assets? A, business or economic. Okay, so right from here, this is the definition, right? We need to keep our business separate from our personal, so A is the correct answer. Okay. Number 21. Okay, under the rules of GAAP, which rule states that when recording a transaction, okay, it should be recorded in terms of money or value? C, monetary assumption, right? We got the hence the keyword here in terms of money, monetary, right?
What was number 19 again? I'm sorry.
Number 19 is A, business and economic. Okay.
No.
Oh, 19. Oh, I'm so sorry. It's B, reasonable. Okay. I will post the answers to this when we complete it on Wednesday.
And you said 20 was A?
20 was A, yes, business or economic entity, yes. Okay. 21 is C, monetary assumption. Okay.
And 18 was all of the above, correct?
Yes. Okay. Let's see what 22 says. So under the rules of GAAP, okay, which rule states that when making a purchase of an asset, okay, they are recorded at original selling price, okay? This value does not change over time.
Yes, B.
Historical cost is correct. Okay? Remember that this is the pure definition, right? You have to record it at original cost that you purchased it at. Okay? So good. All right, number 23, cash basis is when A, okay, revenues are recognized when cash is received. Okay, that's correct. Let's see B, expenses are recognized when cash is readily available to spend. So B seems to be the correct answer too. C,
Yeah, it's D. It's A and B.
yes. C says expenses are recognized when incurred. So the correct answer is, in fact, D, because this is true, right? You only recognize when cash is received. You only recognize expenses when cash is readily available to spend. Okay, so A and B only. All right, question number 24. Okay, accrual basis is when
C.
C. When the expense has incurred, right? Regardless whether you received cash or not. The other two are strictly when cash is present. Okay? So C is the correct answer for this. And that is going to be where we stopped today. Okay? So tomorrow we're going to go over chapter 5 and 6. Then we're going to complete the rest of the study guide. Okay? Any questions for today?